Coming up today, is the stock market in a bubble? GDP data comes in soft, along with a weakening jobs market, a preview of inflation data tomorrow, more crypto ETFs, roaring kitty, Nike gets hammered, and what's different about this presidential debate. Hey, what's up guys? Thanks for tuning in. Daily market review, and to all of those that support this channel, helping to take it over 9,000 subscribers. And so diving right in, pretty similar day to yesterday. Market calling up here on low range. Same with bonds in anticipation of PCE data tomorrow. Also got the presidential debate about to start after I finish this video. By the time you're watching this, it's either already started or it's just finished. All indices finishing in the green today, led by the Russell small cap up 1%. Volume breadth doing okay as well, especially in the Nasdaq 2-to-1. Overall market breadth in the short term, just kind of holding up there a bit today. We've still got stocks making new lows, outpacing that of new highs. And just looking at the VIX one-day index, 10.82 is pretty low. Option dealers are usually right, and they're not pricing in much volatility tomorrow at all, implying PCE is going to come in as expected. And the way you can work out what option dealers are forecasting for how much stocks will move up or down is you take the implied volatility, for example 10.82 on the VIX one-day index, and you divide that by 16. That gives us 0.67. So options markets forecasting S&P 500 is going to finish either up or down 0.67% tomorrow, which is not a big move at all. VIX 30-day still really low here as well, 12.2. What's super low is implied correlation. Dispersion is super high in this market. This is as low as it's ever been, 5.88. And so that indicates a few things, because typically when intercorrelation in the market is really high, when all stocks are kind of moving like a school of fish, there's more stress in the market, and the market's acting overall as one. However, with implied correlations at rock bottom here, that's indicating a lot of dispersion, which means stocks are kind of doing their own thing, trading off their own fundamentals, instead of being heavily influenced by the market. So that's kind of like a stock picker's market, allowing for the generation of alpha, and it's also indicating that the market is quite calm and comfortable, doesn't think there's any systematic risks out there. However, that can also mean we're moving closer to a top as complacency starts to set in. Also looking at crude oil volatility and gold volatility and bond market volatility, all quite tame as well. There's a 2-year yield calling up the last 2 weeks here, going into PCE tomorrow. If we do get a surprise, the market is definitely not prepared for that. Could be a big uncoiling. There's high yield bonds. The dollar still firm above 105. Bitcoin trying to find support around 61,000. If we don't get a good bounce soon, the support may give way. And crude holding ground as well, just under $82 a barrel. And even though small caps led the way today, mega cap tech still had a good day. Microsoft finding new all-time highs, all finishing in the green, bar Nvidia pulling back a bit as well. Amazon breaking up again to a new all-time high on a momentum thrust signal of mine. Alphabet, Google still looking probably the best price action out of them all. Meta close to breaking out to all-time highs, and Tesla finishing slightly higher after yesterday's good day. So looking at the daily chart of the S&P 500, kind of coiling up here, almost looks like a springboard, like we could break out, easily slap on another 100 points, maybe if PCE comes in better than expected, or if not, maybe there could be a big uncoiling the other way. However, for the here and now, the market's trading really thick, low volatility, a lot of dispersion. We'll just see how it reacts after PCE tomorrow. And just stepping back and looking how we're tracking year to date on the S&P. On average for a calendar year, we can see an intra-year drawdown pullback of 14.2%. The biggest we've had this year is 5.5%, currently up about 14% for the year. Tracking pretty good, even for an election year. But what is different is it's more of a skinny rally. In fact, this is only the second year in the last 35 years we've seen the S&P 500 equal weight underperform the market cap weighted S&P by more than 10%. And we're only halfway through the year. And in addition to improving earnings, closing the growth cap with mega cap tech that's expected over the next year or two, what could also help the Russell 2000 index is a rebalancing of it, with more technology and AI related stocks being added. So if the AI boom is going to continue, then the Russell indices could participate in that as well. Broad market breadth help to close the gap with the heavily concentrated S&P 500 and Nasdaq indices. And according to the Bank of America Global Fund Manager Survey, what fund managers rate as the biggest tail risk, we can see that higher inflation pulling back a lot, even just in the last couple of months. But still the biggest tail risk for fund managers, coming in second, geopolitics. The US election sharply climbing in the last couple of months. Hard landing pulling back slightly. Systemic credit event climbing, along with an AI bubble climbing. And looking back in history, quite often you'll see it's what fund managers least expect to be the problem that can turn out to be the problem. And so we very well could be going into an AI bubble, but it could still have a few years left. But for the here and now, momentum stocks are getting crowded, along with growth, definitely the best performing factor this year and over the last rolling 12 months, at the expense of small caps, value, dividend stocks, a lot of international stocks. But like I said, we're not quite in bubble territory just yet. Just looking back in history of 5-year performances, classic classic bull market. Up the top in the blue is the SP 500 from 1995 to 2000. In the orange, from 1924 to 1929, the end of the Roaring '20s. In the green, 1963 to 1968. And in the pink, 2019. Where we are now, 24. So you can see it's quite a healthy bull market, but still nowhere near the returns from probably the top two biggest bubbles in the US stock market over the last 200 years, the late 20s and the late 90s. And so a big part of that huge asset price inflation coming out of 2020, huge amount of government stimulus, Americans' balance sheets actually exploded with cash, along with M2 money supply. Excess saving reached 2.1 trillion in 21. However, all of that excess savings from the pandemic has now been wiped out, and some fear that could cause a material downward shift in consumer spending. We are seeing a little bit of a pullback in discretionary spend. However, just looking at the Goldman Sachs US consumer dashboard overall, and I know this image is a little blurry. However, I can narrate it for you. We're looking from 1980 up until current date, looking at consumer spending. That's flickering between yellow and red. Current percentile, 38. Employment's still good, 79. Income weakening, along with confidence. But what is really good is wealth and debt. So the overall average for the consumer, current percentile coming in at 61, which is not too bad. Bit above average. We can see in 2007 going into 2008. Overall, the consumer was weakening. Same with back in the early 90s, but interestingly, back in the late 90s, consumer wasn't really weakening. But you can see that build up in debt in the early 2000s in the US housing market. Then it kind of just went bust. And so that's the thing. There is a lot of wealth in aggregate across US households. Looking at net worth, percentage of disposable income, not too far off highs. Almost at 800%. So in other words, income could dry up for a lot of people, and there's still a lot of wealth that can be spent. In fact, for a lot of retired boomers with no debt, these high interest rates are good. It increases their income, money market funds, savings accounts, CDs, TDs. But what's interesting is people's expectations have been dropping. In fact, we've got the biggest divergence between downside expectation and the present situation that we've ever seen. A lot of people still grappling with those high interest rates and embedded structural inflation. And looking back in history, typically expectations will start rolling over before we go into a recession, and it could be even a result that a recession just kind of self-manifests itself sometimes. If enough people are convinced the economy is going bad, things are going to get worse, everyone pulls back their discretionary spending, followed by business investment. Next thing, the economy is contracting and we're in a recession. And that could already be showing up in retail investing activity. Looking at retail net purchases of US listed securities, that net flow has been less than 1 billion a day for 45 days now. A lot of retail investors like us just not buying into this rally. And we're just about to go into Q2 earnings season. Typically kicks off 2-3 weeks after the end of each quarter, with most of them coming in Tuesday through Thursday, and we're going to peak out first week of August. And the big ones are normally always kicked off on a Friday with the banks. JP Morgan, Wells, BlackRock, and Citigroup. We got GDP data today, pretty much coming in line as expected, showing the US economy grew by 1.4% in the first quarter, with a forecast for it to accelerate to 2% in the second quarter. And if you adjust that for inflation, it's not all that great. If inflation's really around 3%, looking at everything, it's probably more closer to 4%. So if actual real spending was the same, it should be going up a bit more than that to show actual real growth. However, very well by the end of the year could still come in above 3%, just like the consumer. What's freezing up is the housing market. So many people locked into low rates, just sitting pretty. US home sales fall into an all-time low in May. Hard time for realtors, not being able to move inventory, and that's affecting new home sales as well. You can see that in the price of lumber futures, coming off a lot this last couple of months. And the previously hot home builder sector, definitely taking a breather here. Multi-month consolidation down near the lows as well. And more signs of a softening jobs market, but not by much. 4-week moving average rising 3,000 to 236,000, the highest level since last September. And we'll get a look at consumer spending and income tomorrow. PC inflation. The wide expectation that it's going to show little or no price increases in the past month. Like I said, the market would be really surprised if this came in hot. If anything, it's expecting it to come in tame, so I can give it even more reason to rally. Could see bond yields pull back. Fed fund futures priced in a cut in July. However, going into it, about a 64% chance they're going to cut in September, and same again for December. And if it does come in better than expected, and next Friday we get a slight uptick in unemployment, I'd agree with Raphael Bostic, Fed president coming out of Atlanta, and the fact he even said it out loud. And in fact, he even said the quiet bit out loud. Inflation wouldn't have to fall all the way to 2% for him to favour a cut, and I believe that as well. Jay Powell will come out with a cleverly worded statement to justify a rate cut, even though we're not getting back down into the low 2s on CPI. But for the here and now, bond yields are squeezing up, kind of just anticipation of what's going to happen. At a time that liquidity is already worsening in the treasury market, you can see this in the average yield error. That's the theoretical implied yields of what treasuries should be yielding based on the yield curve versus what they're actually yielding in the market. Indicates wider bid-ask spread, less trading, less participation, starting to get back to those GFC sea levels. Moving on to crypto, we'll know whether we're going to get a spot Ethereum ETF by next Thursday, the 4th of July. The SEC hitting a deadline, whether they will approve them or not. We've also got VanEck applying for a Solana ETF, another type of cryptocurrency. Some saying it's unlikely to be approved. And so this will be interesting. Now that the government over the last year or so has really clamped down on the private crypto industry and those big exchanges, cut them down to size, locked a lot of them up. Wall Street's now the custodian, which is kind of funny given that it's supposed to be an encrypted currency. So if they do allow the Ethereum and then they go on to allow Solana, what's them to stop allowing everything? Should just have at it. Like it's open season. Let's get Dogecoin on there. Who knows? Maybe we could have 100+ crypto ETFs. And if that were to happen, think what would that do to the economy? To have hundreds of billions of dollars just sitting in these currencies. They're non-productive. They don't yield anything. They really just inflate the values for the whales that hold them. Anyway, this one's going to be interesting to see how the SEC goes with this one. And so even though we've had a bit of a pullback in gas and oil demand, actual uptick in supplies, US producing at an all-time record, Russia increasing exports, Biden administration threatening to release more oil from the Strategic Petroleum Reserve, still got oil holding up really well and all in the face of that. Could be worrying over potential increase in conflicts in the Middle East. Still got a flare-up in Israel and Hezbollah. Still got Russia threatening to use nuclear weapons if Ukraine and the West don't back down. Still got natural gas on track for more than a 50% quarterly gain. Got to pick up in extreme weather events. A more active Atlantic hurricane season forecast could cause further spikes for natural gas, but for the here and now, we're pulling back to the 50-day, and crude's just kind of firming up there. May actually come back up and test this resistance zone around $86, $87 a barrel. That's also in the face of a strong dollar as well, which has got the yen under pressure, sitting at multi-decade lows versus the dollar. Moving on to an update from Roaring Kitty, and we haven't heard about his GameStop position, apparently still holding over 9 million shares. Price of GameStop just sitting around his cost average, but the power this guy has for a retail trader is amazing. He just posted this meme on X today of a dog. Next thing, pet retailer Chewy shot up 28%. That's the company GameStop CEO Ryan Cohen founded. Also saw Petco surge 13%. No real indication whether he's taken a position or not. However, Chewy had already been significantly rallying since its earnings. It came out with a really big beat, kind of similar price action in Petco there under the ticker Wolf. A lot of big volume, potential signs of accumulation there. Also just heard from Nike falling hard after hours on a big sales miss, losing market share. Sales falling 2% year over year, and the stock's been under pressure for some time here. It's going down to a 5-minute chart after hours. It's been absolutely hammered for a large cap stock, off 12%. It's pretty big. And that's something I've noticed the last couple of years, especially since 2021. Some of these companies adopting a woke culture seems to really affect their business and subsequently the stock price. We can see on this multi-year weekly chart of Nike versus S&P 500 here in the orange. Huge underperformance from Nike. Same thing with Disney, with their movies and brands not gathering the same attention as they used to. We saw a similar thing with PayPal. They try to impose a social credit score or something. Markets hammered them. Again with Target and their controversial clothing for children, hugely underperforming the market. And another significant one, Anheuser-Busch. Although they seem to have recovered somewhat, still underperforming the market a lot. So I guess it just shows companies that try to project their political ideologies onto their customers. A lot of the customers will just simply vote with their dollars, even though they may remain silent in public. We also had one of America's biggest and longest operating retailers suffer its biggest one-day fall ever. Walgreens Boots Alliance down 22% on plans to close thousands of its stores. Fortunately, going to result in tens of thousands of people losing their job. And according to the CEO, they're at a point where the current pharmacy model is just not sustainable, and they've had to make these big cuts. And they already operate just over 8,700 retail locations, which is quite a lot in the digital age, and they're potentially looking at closing down 2,100. And there's a look at the stock price today, absolutely hammered with their earnings as well, even though they're still making money. And late last year, this is one I was looking at as being a bit of a value play. It held that $20 support really well. We bounced off it, but we came back down. And like I said back then, if it broke that level, which it did with gusto, then it was time to move on. That's why it's important to always have a stop loss, because cheap can get cheaper, and who knows, it very well could turn around. 10 billion market cap does seem really small considering their footprint. However, I'd need to see some stabilization in the price action and potentially signs of a bottom, which I don't think we have quite yet, to think about this one again. Moving on to what's also been weak of late, Chinese securities having a pretty good pullback, and they've just scheduled their third plenum. And these are historically pivotal in setting the direction for major economic and political reforms. The meeting scheduled for July will play a crucial role in shaping the country's economic future. We could hear some new big policy announcements, stimulus, and what direction Xi and his team appointing the country. We'll also get to hear about their monetary policy direction, and believe it or not, they're actually engaging in panda diplomacy again, sending giant pandas to the US for the first time in 2 decades. Going to their new home in the San Diego Zoo, Chinese have done this in the past, gifted pandas to other countries is kind of extending the olive branch, friendly sign. And like I've been saying since late last year, when Xi Jinping came to San Francisco, he wants to come back to the table to do business. Even though he's closely aligning with Russia, he doesn't want to lose the business relationship with the West, and he's looking to get underneath his markets and get them healthy again. But for the here and now, the market is a bit worried with their build-up around Taiwan. Trade tensions with the US, investors still on edge, so this pullback has extended today. However, if I draw a Fibonacci from the bottom of the last swing low to the swing high, pretty much right at that 61% retracement, and if I just go out to a weekly chart, it is a level where the market has made a few turns before, around that 2580 level on the FXI. So we'll see whether that can hold, and their third plenum could be a catalyst that propels the market higher, or the market could get excited going into. With their meeting set to start on the 15th of July, maybe setting up for a good buy the dip before then. And so by the time you're watching this, the presidential debate's probably already over. Be interesting to see how that goes. And I'd like to show you some content from that on tomorrow's show. However, CNN has unprecedented control over this content. Normally I can comment and react on pretty much any content out there under fair use law. However, this time it's different. Quite a few conditions that have been laid on this debate. Even the White House Correspondents Association has heavily criticized CNN for refusing to allow any print media reporters into the venue, basically giving CNN full control over what's being broadcast. They've also implemented a longer broadcast delay. Instead of the standard 7-second delay, they will implement a 1 to 2 minute delay, potentially allowing them time to have edited parts of the broadcast. There's no live audience, and there's mic muting, so the CNN moderators have the ability to mute any of their candidates, which kind of discourages a lively debate, which is kind of what the whole thing's supposed to be about. Anyway, we'll see what happens. And just going into it, sportsbooks around the world, aggregate odds of a Trump win come November, probability still at 55% versus Biden's 36%, and we'll see how that changes come tomorrow. There's a look at the economic calendar today. GDP coming in line as expected, jobless claims a little bit hotter, pending home sales falling off a cliff, and tomorrow, PCE, both core and headline year over year, expected to have grown 2.6%. Fear and greed index bouncing back a little bit on some improving breadth and neutral zone. Corporate insiders going into that summer blackout period. Not doing a whole lot of trading. All right, guys, I'll wrap it up there for today. Just to summarize, the market's coiling up. Same with bond yields. Oil sitting firm. Small caps bouncing back a bit today, but mega cap tech still looking really good on the charts. All but NVDA kind of just pressing up against highs. Even Tesla breaking out again. Options market forecasting really low volatility tomorrow for PCE data. Forecast to come in at 2.6% year over year. And like I said, dispersion really high. Stock pickers market. A lot of stocks doing their own thing. Trading off their own fundamentals instead of market-wide forces. As always, that's the tale of the tape. We'll see what we get tomorrow. Thanks very much for tuning in, and I'll see you again tomorrow night. Cheers.